Hello, this is Mackenzie Box, and welcome to our weekly Market Insights webinar. We are pleased to provide you new insights to the overall market, and thank you for joining our session. Thank you for submitting your questions to us. That really helps us drive the agenda for each week. We really value your feedback and appreciate you taking the time to submit questions in advance. So thank you again for joining us. Now, let's get into it. So quickly, I just want to highlight this is Market Insights. We are not giving any recommendations or advice. We're just simply providing general market insights around the market and things for you to consider as you start to shape your portfolios. So today we are shaking things up on the panel a little bit. Today we have Chris Heeks. Chris is one of the portfolio managers on the ETF side. So welcome, Chris. Thanks for joining. And myself, Mackenzie Box, who I've been on previously before. So just want to, sorry guys. Thank you all for joining, and let's get into it. So first, we'd like to always start off with some tools. Here's one that we highlighted last week. Independent, so this is Stock Chase, and I think Kevin Prince actually highlighted it last week. And this is an independent website that allows you to search by an ETF or a ticker or an individual stock. And what it really does is it consolidates all the various articles that are out there about the particular stock or ETF, and just allows you to have some insight into the particular ETF. So it's a nice, consolidated tool that allows you to kind of get an overall view about a particular ETF or a particular stock that you have questions about. So the topic today is all around alternatives. And I think last week we did a great primer into alternatives, defining them, and speaking about alternative assets. So we're just going to do a quick refresher before we dive in. And I think, alternatives have really risen in popularity in the industry in the last little bit. And when we talk about alternatives, we really need to think about the portfolio construction and how it's changing and how it's evolved over the years. Traditionally, we see a 60-40 equity fixed income split, which has done really well historically. But, when alternatives really excel when equities and fixed income investments are a little bit more challenged. And, when we see in a rising market, investors start to notice that this traditional mix isn't necessarily getting the job done, and they need to be a little bit more aggressive in their search for yield. So as you look at the chart, you can kind of just see that, over time, we've had to shift our portfolio allocation to achieve our desired standard or risk-adjusted returns for our portfolio. So it's something you want to be mindful, looking at your portfolio allocations to just ensure that you're getting your desired yield and desired risk-adjusted returns that suit you. And last week we went through the various different alternatives. So we talked about the benefits of alternatives, looking for something that has a lower correlation to our traditional equity and fixed income solutions. But really, your alternative sleeve is really giving you that enhanced diversification, greater source of expected return, reduced volatility, and the liquidity. So, they're great complements to your portfolio in ways that you can really add value. So last week we touched on some of the different alternative assets, but this week we're going to shift gears a little bit and talk about some of the alternative strategies out there in the market, and some of them more specific to the Canadian ETF market, and some that are more specific to BMO. So we were going to have Chris walk through some of them. And just before I pass it over to Chris, just looking at alternative investing strategies as a whole, these are really used to create a risk return characteristic that differs from your investment stock. So, when we look at these strategies, the more well-known ones that have been used by institutional investors and hedge funds alike are, your long short equity, your market neutral, and your managed futures. So that's kind of the overview of that. Now, Chris is going to take us a little bit deeper and give us some insight into, what BMO has in terms of alternative investing strategies and some of the different products in the market. So Chris, I'll pass it over to you. And maybe first, we know BMO is a leader in the option space. So maybe you can give us a little bit of insight into that.
Thanks very much, Mackenzie, and good afternoon or good morning to everybody, depending on where you're calling in from. Definitely option overlays, or ETFs that employ option strategies have been very popular with our client base, and you can see the assets have really grown. In particular, what you can do with options that I think is interesting is earn that extra premium. So we're very well known for, in particular, our covered call ETFs. Again, we do those on dividend-based underlyings in general, and then options give us that ability to add, 3-4%. So we're going to talk a little bit about covered calls today, and then, talk about a new strategy, which is ZPay, which is a quite a unique strategy, kind of an alternative strategy. Perhaps I should be calling it ZPay. Obviously we're Canadian, but I find ZPay sounds better. We'll talk about covered calls. We'll call those ZWB, Z, WC, etc. But we'll call it ZPay if that's all right. So let's move forward here. So just as a further proof point of kind of that real expertise, we launched our first covered call strategy in 2011. That was ZWB. And quite very simply, just writing cover calls on the 6 big Canadian banks and earning that extra yield. It's been quite an effective strategy, and one that's resonated with clients. Particularly ones that have a little less risk tolerance and have that demand for yield. So quite a market there. And I'll start kind of the presentation. Just once we have that, we'll move to the ZPay. So, just take one quick step back. What's covered call all about? Well, it's essentially trading away potential or a portion of potential upside in return for current income. So like I mentioned, our covered call strategies generate about 3 to 5% extra yield per yield, taxed as capital gain. And we do that by taking a portion of our portfolio and say, for example, like a BMO stock that's trading at $80 right now. We'll say, we'll sell an option with a strike price of $84 a month from now. And if BMO goes to 84 and above, then, we sell BMO at that price. So we sell away a portion of potential upside, and in return for that, we get that extra income stream. Graphically, you can look at it here as owning a stock just outright is this dotted line. Stocks go up, they go down, and you participate, one for one, regardless of the movement there. Kind of the plain vanilla covered call strategy would be the blue line, where you just kind of sell calls on everything you own. We don't actually like that strategy, and in our covered calls, we found what works well is having this mix of growth and income. You always want to have upside exposure to stocks. One of the great things about stocks is they tend to give you positive returns over time. So you don't want to sacrifice all that return. So you can see in the BMO payoff, significantly, we are still participating, and we're at, and if the stocks kind of stay flat or go down, we're always earning that extra income stream. So again, on the Canadian banks are yielding about 5% right now, pretty attractive. I'd add as a side note. Doing the covered call overlay is going to add another 3 to 4% on top of that. So you're looking at a strategy on Canadian banks, which are pretty, I'd say bellwether investments for Canada, that can get you 8 to 9% in gross yield right now. So, and as well, if banks go up, we're going to participate in that growth. So that's the basic strategy of covered calls. Again, what are the advantages of covered calls? They tend to lower your volatility slightly compared to just owning the equities. Obviously, the higher yield is an attraction. Tax efficiency, I mentioned the option premiums are taxed as capital gains. I particularly like that in foreign exposures. If you buy a US dividend strategy or a European dividend strategy, those dividends actually get taxed on your income account as foreign income. But the call options, where we're generating this extra 3 to 4%, are always taxed as cap gains, and there's no withholding tax like you generally have with foreign dividends. So this is our suite of covered calls here. It's pretty built out now. We have got high dividend core strategies in Canada, US, and Europe. As I mentioned, the covered call Canadian banks, ZWB was our first, and we also have some different exposures as well to the Dow 30, to utilities, to US banks. US banks are also quite an interesting value opportunity right now, I think, as well. And our most recent one, ZWG, which is simply a global high dividend covered call, really had great performance. So again, these are great tools to generate yield, and doing it in a little bit different way than just a typical dividend fund. Again, we're getting dividends in these portfolios, but we're also using the option market to generate the yield from options. And I think just one point as we, it's pretty interesting to use the volatility of the option market to generate yield. Volatility is not a good word usually when it comes to equities and bonds. Volatility is generally a negative for those assets, but one side benefit is volatility is can actually help us generate yield better in these option-based strategies. So as we move forward, sorry, go ahead, Mackenzie.
Thanks, Chris. I think that's great. And I think the other thing I would just want to highlight is, BMO has obviously a very robust suite of covered calls in this space. There are some other providers in this space that do have some in the Canadian market. But as Chris was saying, it's a great, if you're looking for that yield and complement to your portfolio, these are great solutions to look at. So switching gears a little bit, we're gonna dive deeper now into premium yields, and I know we've mentioned this previously on some of our other webinars. There's BMO recently launched a premium yield ETF back in early this winter, and we've seen some great traction on that. But there are a few other providers in the space, and Chris is just going to give a high-level overview, of what's available, and then also dive a little bit deeper into, as he said, ZPay, and kind of give you further insights on how you can use it in your portfolio and just help you better understand the strategy.
Thanks, Mackenzie. And I think I'm calling it ZPay today, but ZPay, it all works. Small reminder, ZPay is it's an unhedged strategy, but we also offer it in a hedged .F unit and a US dollar unit as well. So we might not touch on that again. I thought I'd mention it now. Lots of choices to currency exposure and what works for you. But overall, the space, it's a relatively new one. You can see Dynamic and Purpose also have existing strategies. Ours is the newest. We're almost at 300 million right away, which I think is a tremendous success. All of them earn you or they afford you the ability to earn yield, a good level of yield. You can see the kind of yields range from 6 to 7%. And all of them give you some exposure to equities. So now here's where we're going to start differing a bit from the covered calls. Whereas a covered call generally gives you 100% exposure to equities. It's an equity fund with a covered call overlay to generate incremental yield. What you tend to see though with the premium yields is partial equity exposure. So why don't we dive into the strategy a bit deeper and we can get a better understanding of how ZPay works. Again, a lot of the same benefits as you would see with the covered call. There's a tax efficient yield, there's lower volatility, and certainly only holding a portion of equities kind of lowers your volatility, even quite a bit further than a pure equity strategy. But what we're doing, and this would be true of the competitors as well, but this premium yield space is generally, like I said, have some equities, We write covered calls on those equities, and we do it in just the same way we would do it in our covered call ETFs. We write on about half the portfolio. We want to make sure we're always balancing that trade-off between growth and income, making sure we get that long-term growth that's going to come from holding equities. And then what we do on the other side as well is we write puts. So, this will become, I think we've got a couple graphics coming up, but we'll write puts where what we do is we identify, stocks we want to hold as equities. For example, Apple's a $500 stock right now. Apple's a high quality company and we like Apple, but we would rather not pay $500. What we can do is sell a put, and the put kind of works opposite to the call. And we'll say, okay, in a month, we'll sell a put at $450, $50 below the current price. And we're going to earn a good yield for doing that. And if Apple does sell off and goes below $450, then we're going to buy that stock. So whereas covered calls, if it rallies, you sell the stock. And with puts, what you're looking to do is actually buy the stock at lower prices, and you earn a yield for taking on that risk. So that's what we like to do. And doing the puts tend to give you even better income than the calls. But the nice thing about it is regardless of whether you're writing puts or selling calls, we're always doing both and we're always benefiting from both. So where our equity range tends to focus is 20 to 50%. Kind of a neutral weight we think is about 1/3 equity. And so what we'll do is we'll do covered calls on that 1/3 equity. That's where we get our long-term growth. Our market participation tends to come from stocks. And then on the other side of the portfolio, the other 2/3, we're going to sell those puts. And again, we're going to sell puts on stocks we actually want to own. And we're going to earn some good yield on those puts. And let's go to the next slide. We could show you kind of what's going to happen in this portfolio over time. There's really two things that can happen. So you look at the put side. We're going to sell puts on 2/3 of the portfolio. There's two things that can happen. The put can finish out of the money. So for example, let's say Apple remains around $500 for the next month or so. It's actually doing a stock split tonight. So Apple will be doing a 4-for-1 stock split. It'll be going to $125, but ignore that for a second. Let's say the stocks stay about where they are. Then the put finishes out of the money. We keep the premium, and we're going to just keep doing it again, on the stocks that we like. Now, if Apple does sell off, that put will go in the money and we'll buy the stock. So again, the puts are functioning really in two really great ways for us. Number one, they're generating, a substantial amount of yield. And number two, they're giving us an ability to potentially buy stock that we really like at lower prices. So I think it's a really effective way to use these puts to manage the equity exposure. Then on the other side, on the stocks that we own, they're giving us that exposure to long-term growth. One of two things can happen when we do that cover call strategy. Let's say stocks stay around where they are. Well, that's fine. We'll keep the premium and continue to write calls on that stock. Let's say those stocks rally further. That call may be in the money. You know what? That's going to give an opportunity for us to sell stock. So if you look at what we're doing here, on the puts, gives us the ability to buy stock low. On the calls, if the stock rallies, we're going to sell high. So as we will go through here, you'll see this buy low, sell high is really embedded into the whole methodology of the fund. So it's it's a lot of technology there. Let's maybe walk through an example. I think this is pretty instructive. We launched this fund in January, and certainly, to say the least, we've seen a lot of market movement in that time. You look at this price of Nike, and this is just through about mid-April, but from the beginning of the year through mid-April, and obviously there's a COVID-related sell-off that happened, and this shows you kind of the first leg of the recovery that happened through April. Nike is actually back over $100 now, so it's recovered quite even a bit further from there. So anyways, look at step A, point A. Late February, we sell a put. So Nike's trading at $90. We sell a put to point B with a strike price of $70. Now, what happens? Well, obviously, we know COVID led to a significant sell-off in the market. What happens is that put goes in the money and we buy Nike for $70. buying Nike for 70 is, I think, much more attractive than buying it for 90. And COVID, while it's obviously, this is a global crisis we're dealing with, the opportunity to buy stocks in March was very, very attractive for those who were able to do it. And that's what this strategy is able to do. When the market sells off, it looks to get more equity. So that's what happened. We bought Nike, a bit below or right at $70 actually. And then we start selling calls. So we sold a call option to point C. It didn't go in the money. We sold an $82 strike. And by that time at point C, around only $72, so it wasn't in the money. But at point D, that strike did go in the money, and we sold the Nike shares for $82. I'd further say after that, then we go back to selling puts on Nike. So we're still selling puts now and waiting for another sell-off to buy the stock again. But again, you can see we bought Nike at 70, we sold it at 82.50. That's a nice profit. And even at the times we didn't own the stock, we're earning a lot of yield. So that's really how the strategy works. So, looking, let's take a step back, look at performance of the overall portfolio. On the left, you can see the price return. ZPay is in white, and ZSP, which is our S&P 500 index ETF, is in the orange. Number one, you can see, this COVID sell-off, we go for that, but the primary one is we only had 35% equities when we started, so we go down much less. There's nice protection there. You'll see we perform pretty well coming out of that sell-off. So that first April and May returns, we actually participate in a lot of upside. And that's because, like Nike, we actually bought a lot of stocks in March. March was a good buying opportunity for stocks. And part of this put strategy is it helps us make that right decision to buy the stocks when they sell off, to buy low. Now I'll say another word on that in a second on the next slide, but the other graphic to take a look at on this slide is the risk levels. So again, ZPay is in the orange this time for the risk. It's about half the risk of the market, the S&P 500. And as we recall, this gives you a nice risk reduction for this year, significant risk reduction, but it's actually giving you about the same return as the S&P 500 this year. So let's go next slide, and this will go back to my point about March and what we did. I called this slide zigging when the market zags. The red line is the index. That's the S&P 500 index level, and obviously it's started the year over 3,000. It went down. These are just monthly data points, but it did go down significantly in March and April. The blue line is actually the equity exposure in ZPay. So we started the year at 35% equities. As that red line went down, that's when we bought equities. So as equities rally coming out of that March low, again, we start lightening up on our equities. So this buy low, sell high effect is really key to the ZPay dynamic, and is something that really allows it to succeed, to have succeeded this year in quite a challenging market. The portfolio, so again, now we're kind of back to where we started. You look top left, our equities are 37%. The rest of the portfolio is in T-bills, and that's the portion we do the puts on. The puts right now are about 12% out of the money on average. That means, if Nike's at $100, our put on Nike right now is about 88, and we're waiting for Nike to get back to $88, and we're going to buy some more. The calls are about only 1% out of the money, and that's consistent with the market rally. We're at record highs on the S&P right now, so that's why our equity is lightened up. We're broadly diversified by sector. Our number one sector exposure is IT, and that's certainly a sector that's paid off for the fund. IT has been a major leading sector this year. The NASDAQ has had tremendous performance if you look at it compared to something like the Dow Jones Industrial Average. So very well balanced and very well positioned. Again, if there's more volatility this fall, and we kind of think there will be with the US election, it's going to give us a great opportunity to buy stocks. And you know what, if the volatility doesn't come to fruition, that's fine. We'll keep earning our 6 to 7% yield. So I think we're in a very good position to navigate what should be, another interesting fall. And lastly, this is a screenshot from a report that we produce on a monthly basis. Something we really believe in at BMO ETFs is being transparent, keeping you up to date, telling you what we're doing in the portfolio. Here we give you some statistics on the level of yield that we're earning and where those options are, what percentage of the portfolio is covered. I draw your attention to the annualized option yield. Again, on those puts I mentioned, we're earning 4.7. On the calls right now, we're earning 3. So this strategy is kicking off about 7.5% yield right now, and even a little bit more from a little dividend yield on the stocks. So again, on a monthly basis, keeping you up to date. Mackenzie, do you want to speak a little more to the resources we have and where people can find them?
Yeah, sure. Thanks, Chris, and thanks for all your insights around ZPay. I would just highlight too, in the last slide, Chris highlighted some holdings. That information is all available daily on our website. So if you're ever, want to dive a little bit deeper and see what the like in terms of what equities it's holding at that certain point in time, everything is all available on our website. And then we also have some more in-depth reports available on our website as well. So I would encourage you to go and look there if you're looking for a little bit more information, as well as some strategy reports about the particular strategy as well. So I would definitely encourage you to check out our website and to stay up to date with everything around whether it be covered calls or ZPay.
Yeah,
So,
thanks,
Chris,
Mackenzie.
why don't you just give us a quick summary of everything? I think there's some great points you highlighted, buy low, sell high, or sorry, sorry, I
You got it
messed
right.
that up.
Buy low, sell high.
Buy low, sell high. Sorry. I think that's a great takeaway, and really a great thing to highlight to everyone. And I think the trade example really went into great example of how the strategy actually works. So I appreciate that. But if you can give us some quick key takeaways, then we'll go from there.
Yeah, absolutely. I mean, I think the buy low, sell high is a great strategy. And one other thing I'd mention about it, and perhaps in contrast to some of the competitors that we displayed later, is this is a very systematic approach. We have a systematic way to identify what stocks we believe are high quality stocks. So a systematic way to approach that, and a systematic way to write the options. So it's rules based. We don't let our emotions get too much in the way. Obviously, as portfolio managers, we have to ensure the product's performing as it should. But the systematic approach, the discipline, really did pay off in those COVID markets, and you could see the buy low, sell high worked very well. In terms of the opportunity right now, obviously yield is a very effective opportunity. It's 6%, but you saw in the fund we're actually earning about 7.5 right now. But the ETF is distributing about 5.9%. Tax efficient, the bulk of it. So all that option yield is on the capital gain account. What I also like in terms of position, and kind of spoke to it, was markets are obviously quite high right now, and people are concerned. You would say, well, maybe this isn't the time to go all in on markets. If you're looking for something to hedge your exposure, this is a great strategy. And then you can kind of get paid, we call it getting paid while you wait. You're going to get that 6% yield, and you'll get paid while you wait for stocks to sell off. And perhaps with the US fall election, that might represent a period where there might be some volatility in stocks and give us some more buying opportunities, or perhaps coronavirus, there's further problems with a second wave or the reopening of the economy. So I think it's a great strategy for the fall, to kind of hedge your bets and get paid while you wait. And if markets do sell off, we're going to be there to buy some stocks, and we want to do that when we're presented with good buying opportunities. And last but not least, we're the leaders in this option overlay space. We showed you the market share we have in the cover call space, and we're off to a great start with ZPay. So, we're really, I mentioned the systematic approach as well, giving benefits, but we're really excited about this solution. So, we look forward to talking about it more and continuing to provide that opportunity for our clients to generate yield and get some really good equity exposure at good buying opportunities.
Thanks, Chris. Yeah, I think when you're looking at alternative strategies and just rounding it out, a very attractive yield at just shy of 6%. So, when you're looking to complement your portfolio, I think this is something that is definitely worth considering and something to keep your eye on. So appreciate the insights. Now we're just going to shift gears to a few questions. I know we're tight for time, so we might just get through two of them. But we'll pass this one over to you, Chris. So, this is coming from someone looking at the correlation between the NASDAQ and the S&P 500. It's asking, is there a point of owning both the indexes at this time? And then, is there an ETF out there if they are looking for the S&P 500?
Yeah, good question. They're both large cap US equity indexes. The last time I checked, the NASDAQ this year is up about 30%. The Dow is up flat. I know the Dow wasn't mentioned in the question. The Dow's flat. The S&P is up about 10%. So, the short answer to the question is they have given quite a different return profile, certainly this year. NASDAQ's much more tech heavy. There's also some biotech. And certainly to say tech has been leading the market, I think is even an understatement. Tech is by far the best performing sector in the market. Tech's about 25% in the S&P 500, but it's a much larger weight in the NASDAQ. So if you have that view on technology, having a little overweight to the NASDAQ can help you achieve that. And for me, I'm pretty bullish technology as a general, kind of strategy. I think that is the way the world's going at a very high level. That being said, the S&P gives you 25%, perhaps a little bit more, 27, 28% exposure to tech. So it's definitely a good vehicle to get that overall US large cap exposure. And certain segments of the S&P that haven't performed as well, say like US banks, for example, you're going to get that exposure in the S&P, whereas in the NASDAQ, you wouldn't get that. So NASDAQ's a little more sector skewed, whereas the S&P is more of a broad representation of the market. In terms of good ETFs, well, there's a couple we have in the S&P. ZSP is the S&P 500 unhedged, and then we have ZUE, which is the S&P 500 hedged to CAD. Currency is kind of a separate topic, and we don't have time to get into a ton. You have to look at your overall portfolio, but having some US exposure in your portfolio tends to be a good thing. What we saw in Corona sell-off is, as equity sold off, the US dollar rallied. So if you're holding the ZSP, the ETF with the currency unhedged, that's a beneficial exposure. So that's something for you to consider as well. Both are going to give you the underlying return of the equities, and again, the ZSP is going to give you the return of US dollars as well. So those are our biggest funds, and certainly ones that you want to have exposure to US equities, certainly going forward for the long term.
Thanks, Chris. Next question. Gold's been a hot topic in the news. We've seen a lot in the media. I know we've done a few seminars focusing around gold too. But this question here relating to, talking about gold stocks over the past year and how they've underperformed versus physical. So just some insights, maybe Chris, you can give us on, what you expect gold miners to perform. Will they perform better this time around? And then is silver or platinum exposure going to have a better outlook?
Yeah, so gold is it's a very, it's one of these more fickle exposures. One of the great things about gold in general is that, it does help you diversify your equities really well. And in general, gold performs, at really advantageous times from an equity point of view. Often golds perform well when equities are kind of going down or kind of, in the dumps a little bit. And so the last big gold run 2009, and I kind of say it's fickle because then for many years after that, you didn't get a lot out of gold, and you certainly didn't get a lot out of gold equities either for quite a while. But they've come to life this year. Since the low, the gold miners, our ZGD ETFs, up about 80%. Gold's up about 15 since that time. If you look at a year-to-date basis, I believe the gold miners are up about 38 versus, I believe, 25 for gold bullion. You tend to get more leverage out of the gold miners versus just the physical gold, and that's because the miners have a high amount of fixed costs, so they're very sensitive to the price of gold. Obviously, leverage can work for or against you. But that being said, I think the back right now, I think because the backdrop for gold is good, given all the stimulus that's happening. Warren Buffett just bought $500 million of Barrick. So gold has, and I believe he said something to the effect of the backdrop for gold is essentially perfect right now. So number one, that's a good thing. And then number two, the stimulus continues to impact stocks in a positive way. So when you have gold miners, which are half gold and half equities, I think both sides of that equation are looking good. So I think having some gold exposure in your portfolio definitely makes sense from a diversification point of view. You don't want to go too heavy. It's quite a volatile exposure, but I think a little bit, there's a lot of room for gold miners to recover, and I think it's something investors can look at, having some gold exposure in their portfolio. Silver and platinum, silver is similar to gold, known to be a little bit more volatile. Not an expert on platinum. It's certainly a more niche exposure. I think you really get what you need out of gold. A lot of the gold producers also have kind of silver byproducts, so you kind of get a silver production through the gold miners as well. A lot of them have they co-produce gold and silver at the same time. But the gold is much pricier and much more valuable, so that tends to be what you hear about. So I tend to stick with the gold unless you had a really strong view on those underlying markets, the other ones.
Great, thanks, Chris. So just in the interest of time, we are going to cap it there today. So thank you everyone for joining today. We're going to take a break next week, rolling into the long weekend, and we will be back on Friday, September 11th with NASDAQ in a two-part series. So thanks again, everyone, for joining. Send in your questions for next week, and if we didn't get to them this week, we'll tackle them in 2 weeks from now. Thanks so much and have a great weekend.